FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's June 25th, 2019. Well, hey, first, let me emphasize again, Bitcoin contest is taking place now. You have until July 14th to enter, and the concept's real simple. Got to get as close as possible to Bitcoin on its exact price on midnight of July 20th. Easy to enter. You just send an email to kl@kerrylutz.com and put in the subject line Bitcoin or Bitcoin followed by anything, and then tell me your prediction. Mine is 6650. You got to get closer than me. If you are the grand prize winner, you will receive 40 90% silver quarters. That's right, pre-1965 quarters. For the first 5 runner-ups, you'll each get one pre-1965 quarter. Real simple. If I get 1,000 entries into the contest, I will up the grand prize to 100, right? That's 100 pre-1965 quarters, and each runner-up will receive 10. So keep those entries coming. I think we're up to about 400 or so. We still got time, so keep them coming. Hey, we got a person I think you're going to want to hear from. Interesting website, interesting predictions. His name is Jim Welsh, and you find him at macrotides.com. And Jim, welcome to the show. So you're calling a top in the market. You think it's been in a topping pattern since 2018, and you think we got a little bit more bang to go, but that's going to be it.
That's pretty much it, Kerry. Thanks. I'm very glad to be joining you. Basically, from a charting analysis, if you look at the high or since the high in January of 2018, the S&P 500 and the Dow Jones Industrial Average have been tracing out what is called a megaphone. And just as you envision cheerleaders standing on a sideline with the narrow part by their mouth, and it widens both as it goes further away from the cheerleader. That's what's happening with the S&P. So you get higher highs and higher lows, which is exactly what's been taking place. After the high in January of 2018, the S&P dropped to 2530, then a new high above the January 18 high in September. Of course, the big sell-off into December last year, which was lower than the February low, and then the subsequent rally that the S&P's had, taking it to a higher high. So the trend line on that megaphone connecting the prior highs is around 3,000. So I think there's a little bit more upside, as you just noted, but this pattern suggests that there's a real probability that the S&P will subsequently, over the next 3 to 6 months, decline to under the December low. So I think there's more risk than reward in the very near term.
Mm-hmm. So I guess we should say that we're seeing higher highs and we're going to see lower lows, and that's what gives it the megaphone pattern, correct?
Yes. And to put it in context, the high in January of 2018, I think, was wave 3 from the March of 2009 low. So you had wave 1 up. Wave 2 was the sell-off in the fall of 2011. Wave 3, January of 2019. And all this choppiness is wave 4. And if this pattern continues to unfold as expected, after there's the decline to below the December low, that would complete wave 4, and then would be followed by a new rally that would take the S&P probably close to 3,500, but comfortably above 3,000. So it's at that point that the market would be vulnerable to a much protracted and deeper decline. So I want to put that in the context of, okay, this sell-off might be pretty vicious and ugly, just like what we saw last December, but I think it's actually completing a correction that began back in January of 28 and should be followed by a fairly significant rally.
Okay, so you're a technical investor, obviously a technical analyst. When we look at the price of gold, we see another really interesting formation that has just broken. We see what we would call a channel, a narrow channel right between like 1363 or so, or 1380 down to, well, we saw it go below 1200 in 2015. But if we kind of throw away the highest point in that channel and the lowest point, then we get to about 1150 and 1350. So we have a 200 point channel that's just very narrow. If you look at you look at that 10-year chart, and from July or June of 2013, it just goes completely sideways. And then we had a couple of these inside years where I think in 17 and 18, the peak price was not as high as the year before, and the low was not as high. Was not as low, rather. So, right, high not as high as the year before in 16, low not as low as the low of 2016. So you get this inside year, which is a further compressing of that channel. And now we've seen it blow through the technical upper end, which was around 1363, call it. Now it's at 1430. I mean, it's up another $12 or so the ounce, which is pretty remarkable. So when you see, first tell us the significance of, Jim, of a sideways narrowing channel and what you see happening with gold here.
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming. Led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Well, from the high in September 2011, gold dropped from 1920 down to about 1045 in December of 2015. And then, as you noted, Kerry, it's been, chopping up and down for almost 3 full years, with the highs being at 1375, 1365. And now we've effectively broken out of that. My expectation has been that gold was going to move up towards 1440 with a possible move up to about 1480. That would be a 50% retracement of the decline from 1920 to 1045. In the very short term, his sentiment has really swung rather dramatically just as the price has moved up. So there are now more than 90% bulls in the gold futures pit. And then the other thing that I look at, which is very, very helpful, is looking at positioning in the gold futures market and looking at what large speculators are doing relative to commercials. And what we can see is that back last fall, large speculators were actually net short. So as gold was bottoming near 1160, the trend followers had completely bailed out. Now what we're seeing, Kerry, is gold has surged. And the last data point is through last Tuesday, the 18th. So it doesn't capture this huge run-up we've seen over the last 5 trading days. But the large speculators, being trend followers, have really jumped on it. So in yesterday's weekly technical review, my advice was basically sell gold, GLD, IAU at price, at 1372, 130, 525 at this morning, and to sell the gold stocks because I think they're vulnerable in the short term to what could be kind of a vicious pullback. So technically really overbought. Positioning, I think, is starting to, will show that the commercials have established a really significant short position. And with 90% bulls, to me, this is what one should do, is sell into strength. When everybody else is jumping on the bandwagon, I'm kind of a contrarian at heart, Kerry. So I try to lean against the crowd and use various gauges of sentiment and positioning to identify when extremes are being met. So last fall there were extremes, less than 10% bulls in gold. The positioning was very constructive. We're seeing pretty much the exact opposite at this point in time. So that doesn't mean longer term gold can't make higher prices. I just think in the very short term, it pays to lighten up a little bit.
I couldn't agree more. My prediction, and I'm not a technical person, but I do follow technical indicators, is this has gone too far, too fast. It's due for 100 plus pullback, maybe right to 1,300. And then it's going to remain there in that 1,300 plus range until fourth quarter when seasonal factors kick in, as well as fundamental factors. And then we'll see the continuation of the bull for sure.
Sure.
But, like very few of the so-called experts, you always see experts disappointed, experts surprised. Well, all the experts are surprised that gold has gone up. The only people who aren't surprised are the people who've been following it for years and knew from that sideways channel that, no market goes straight up. It's going to have a pullback, but it's going to then advance and break 1,500. I don't think we're hitting 1,500 now. I'd be really surprised. The advance has been too fast, too strong. But Jim, like 90% of your advance in a bull market happens like 10% of the total days of trading. So this is a classic example. So silver, though, has not joined the rally, and that's another reason for concern. We've seen a widening of the gold to silver ratio, over 90, and silver probably is going to have to wait till the end of the year, huh?
Yeah, again, I think, as you just pointed out, silver lagging as badly as it has is not a good sign. And again, partially it's responding to economic outlook of slowing and so forth. It's more of an industrial metal. But at the end of the day, looking at the price performance between gold and silver, the best bull markets happen when they both move up together. And, that obviously isn't happening at this point in time.
Yeah. I could not agree with you more. Felt, it's not that this is a fake rally, right? This is not a fake rally, is it?
Well, it's real. I mean, you can, if you bought under 1,200 and you're selling at 1,340, that's real money.
That is real money. Yeah. I mean, we had a high today of 1439.40. So I don't want you out there to think that I'm getting all enthusiastic and saying, this is it, we're ready. There's other things, other factors at play here, but it is the start of a new or extended bull market in precious metals. That's what I'm taking away from it here, Jim.
Yeah. Again, I'm more of an intermediate trader, Kerry. I mean, I look at the long-term charts and everything, but in terms of catching 3 to 6 month moves, I rely on sentiment and positioning in gold. And that's been very, very helpful, especially over the last 3 years, in part because of the trading range. And we've hit extremes, in terms of gold selling off sharply, everybody gets negative, then you get a nice rebound, everybody jumps on the bandwagon. But I think, given the power of this move, the breakout, my assumption is that, yes, after a pullback, I would be very surprised if there isn't another push higher over the next handful of months. And where it goes, we'll see. But I think in the near term, my guess is that China and Trump, when they meet at the G20 meeting, are likely to restart talks. And to the extent that that has contributed to the recent strength in gold, and it might be a little bit, and also Fed policy playing probably a more significant role. But after a big move up, as you just pointed out, too far, too fast, any excuse to take money off the table qualifies. And if I'm right and they do decide to restart trade talks, I don't think they're going anywhere. But that alone could be another trigger as to why people decide, it's time to take some money off the table in gold. And the gold stocks, which have had a phenomenal run, would obviously be more vulnerable to a deeper pullback.
Yeah, we have started to see the majors, your Barracks, your Newmonts, start going up, right? But we haven't seen great participation from the juniors at this point. Some have gone up, some highly, I don't want to say they're all speculative, but better positioned stocks, near-term producers.
That might actually be positive, Kerry. I mean, from a longer-term perspective, in the sense that the most speculative stuff has a tendency to really run when you're nearing the end of a move with gold and the gold stocks. So the fact that they haven't fully participated, suggests that, okay, you get a pullback, but there's more to go. There's more in the gas tank to power it up. And when those juniors start to really fly, that's when, in a sense, the trend is probably getting long. And, it's a sign that it's nearing an end because people are jumping on the most speculative sector of a very volatile sector. So in the short run, that I think is probably more positive than a negative.
Hey, Newmont close at or near 52-week high, Barrick similar. So you look at this and the cycle, it's a little ahead of itself, but Barrick, is at 52-week highs. So that is significant, and it could definitely indicate an intermediate top for sure. Then again, we've got a lot of black swans, and some of them are starting to crash into each other. So one has to wonder about it. But when we look, history is our judge. I tend to think you're correct. Hey, what other markets you're following and that you think are noteworthy? You follow petroleum?
Not especially. Primarily, the U.S. equity market, bonds, foreign currencies. I've been looking for the dollar to pull back. Again, positioning and sentiment got very extreme, in terms of people being bullish. My expectation was the dollar index would drop, not in a significant way in the short term, from over 98 down to 95. Then it gets a bounce and maybe dips a little bit further. I thought that would ultimately be somewhat, would turn into a tailwind for gold as opposed to the headwind, because the dollar has held up pretty well. Yes. I think the one thing I really do a lot of fundamental analysis, Gary, and I try to tie the fundamental analysis with the technical, and there aren't too many people who do that. And I think the Federal Reserve has obviously been kind of a focal point, and I'm not sure people are really right in their assessment. The markets are pricing in 3 Fed rate cuts between now and the end of the year. And yet, when you look at the Fed's projections for GDP this year and next year, they didn't change. They stayed at 2.1%, which is what they said in March. They're at 2.1% for 2019 here after the June meeting, and telling me they actually expect GDP to be a little bit stronger in 2020 from, at 2% up from 1.9. So I think the Fed is in this tough place, is that when you look at the U.S. economy, unemployment is at 50-year lows. Wage growth is north of 3%. Consumer confidence is still pretty high. There's a lot of good things happening. The area that's really weak is related to trade, and that's manufacturing and the decline in oil. So if you look at the ISM surveys, the manufacturing is weak, but the services was north of 56 last month. So the Fed, I think, is they're in a tough spot in the sense that they're waiting to see how the trade stuff plays out. And I believe in interpreting the dot plot, which is the individual projections by each member of the FOMC. At the June meeting, 7 of them were looking for 2 cuts. 1 was looking for a single cut, with 8 unchanged and 1 looking at it for an increase. And the way I'm looking at this, Gary, is that I believe what the FOMC is saying is if President Trump levies more tariffs on China, on the $300 billion that aren't currently subject to tariffs, I think the Fed is going to move aggressively, and they may move in between meetings. So if talks restart in the short run, but sometime, let's say in mid-August, because the Fed meets on July 31st, if the economic data comes in okay, especially the jobs report, in other words, jobs growth of 125, 150,000, wage growth 3.1 to 3.2, I think there's a decent chance the Fed may not cut rates at the July meeting. And if that's the case, that would be another reason why gold could have a deeper pullback. It also, I think, would make the equity market potentially suffer. Oh. But if in mid-August Trump does levy tariffs, I think the Fed will move without waiting for the next meeting and potentially do a 50 basis point cut. And I think that's what the dot plot is suggesting, is that if things deteriorate on the trade front, we will move quickly and aggressively because they don't have a lot to work with. Fed funds are at 240, so they have about 10 cuts. I think potentially they will actually do a 50 basis point cut to maximize the effort and potentially do it intermediate to make that point.
Interesting.
So the next 2 months are going to be really interesting in terms of how the Fed handles what's going on in the economy and balancing that with what the trade stuff is.
All right. Well, hey, we're just going to have to see. My gut feel is the rate cut's coming. I just don't see what choice they really have, because if they don't cut the rates, everybody else around the world is cutting rates, going to lead to a higher dollar. That's not really what they want, and it's certainly not what Trump wants. So I'm expecting.
Yeah, but Kerry, let me point out something, okay? Because I get it. The logic of rates going higher in the U.S. or not dropping like they are other countries, logically, is, the dollar has to strengthen on that. But look at it. The dollar peaked at 103.80 in January of 2017. Mm-hmm. The Fed raised interest rates 4 times between January 2017 and March of 2018, and yet the dollar went from 103.80 to 88.25. Mm. So this correlation between what a central bank does and the currency, it doesn't hold water all the time. And I think that's a trap that a lot of people get into. And since I follow currencies pretty closely, I see it happen often. So just because the Fed doesn't move, to me, doesn't mean that that the dollar automatically is going to rally in any a significant way. That it's going to get above 100 and so forth. Because I've seen a lot of people make that point. They may turn out to be right, but it might be for other reasons than what happens with the Fed.
Oh yes, there are a lot of factors at work here. And there's a lot of money flowing from Europe into the U.S. People are waking up and realizing that Western Europe ain't what it used to be, and it might be a good time to salt away some money in the final, the best looking horse in the glue factory. I'm talking about the U.S. dollar, and that is a big deal. What's happening, and then debt repayments of dollar-denominated debt is bringing in a lot of money. I think it's putting a floor under how low the dollar can go, but you never know. Trend is your friend, and trend in motion remains in motion until it stops. Trend is your friend until the end. So we're just going to have to see. So Jim, I guess the best place to find you is macrotides.com.
That's correct. Right. Jay Welsh at macrotides.com or jimwelshmacro@gmail.com.
All right. We'll have a link to your site, as always, in the show notes. Don't forget, enter that Bitcoin contest. Make sure it has Bitcoin in the subject line so I don't miss your entry. You could be the lucky winner. Let's get to 1,000 entries, and we will up the grand prize to 100 pre-1965 U.S. quarters. These entries are coming in at such a rapid rate. I got 10 just while we were talking here, Jim. Thanks so much for coming on. We'll talk to you again. Be well.
Thank you very much, Gary. Appreciate it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.